The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone. My name is Pam Seifert, and on behalf of Homebridge Wholesale, welcome to the third installment in their TRID webinar series. During the course of this webinar, please feel free to ask any questions in the question box in the webinar panel. We're going to try to address some of these or most of these during our Q&A, depending on the time we have left. So before we begin, I do have a couple poll questions for you. Let me just launch my very first one is, we kind of want to know who's with us today. So are you a broker, a lender, a realtor, attorney, other? We could just take a couple of minutes, or a couple more seconds, I should say, not minutes. And it looks like we are going to close this out right now. And I'll share with all of you. So it looks like we have a lot of brokers here, so welcome. 77% of the broker community, 15% lenders, 30% realtors, and 4% others. So our second question that we have today has to do with the delay. And we want to know, how happy are you that it's been delayed and not August 1st any longer? So are you doing a happy dance and over the moon? Or are you disappointed because you couldn't wait to dig into the regulation? I'm going to close this out in just a couple seconds. And I will share with you. So 87% of you are so happy, and you are taking this extra time to learn and join more webinars that we're offering to you and really digging more in. And 13%, I guess we're ready for August 1st and could not wait to start. Well, that is surprising, but good for you. So I'm going to hide these now. And I do want to let you know, because I already have received some requests for a copy of this presentation. You will find it on www.homebridgewholesale.com. And under the heading Work With Us, you'll see a copy of this presentation as well as our previous presentations. You can also hear the recorded versions in the Google Plus when you scroll down to the bottom of the website. So without further ado, I'd like to introduce Michael Grant, who is the National Sales Manager for Homebridge Wholesale. Michael?
Thank you, Pam. Before I get started, I always wanted to ask, what was that other? That is always an interesting comment to figure out the other part of all the other attendees. But as Pam did say, I want to thank everyone for joining today's TRID presentation. And I want to also introduce our presenter. We're extremely excited to have Benjamin Olson conducting today's TRID presentation. Just to kind of give you guys a little background on Ben, he's the former Deputy Assistant Director for the Office of Regulations at the Consumer Finance Protection Bureau, obviously also known as CFPB. He's also a partner in the Washington, D.C. office of Buckley Sandler. He's intricately involved with the preparations for upcoming changes in regulations, particularly the CFPB's final rules and disclosures forms integrating regulations governing the mortgage origination and settlement process under TILA and RESPA. So with no further ado, we'd like to bring in Ben. Ben, all yours.
All right, thank you, Michael, and thanks everyone for listening today. And I guess based on the polling, I'm the only attorney on this call, so I'm on my own. And I will say that, you know, I'm sure the 87% of you who said you were thrilled with the delay couldn't understand why there were 13% of people who would answer otherwise. And I will say it's been a similarly mixed bag amongst the clients I work with, and there are folks out there who feel like they're ready. They've invested a lot of time and effort in being ready on August 1, and they would have preferred to just sort of go ahead and rip off the Band-Aid. But here we are, and I'm just going to talk, very briefly about the delay in the effective date. As indicated on the slide here, and just as so you know, a general approach to these slides, trying to give you on each slide excerpts from the actual materials, so you have the CFPB's own words that you can refer back to later, rather than my words. But I'm not going to sit here and read all of this to you. That wouldn't be an interesting experience for anyone. So I'll just sort of breeze through some of these. The key point here is that on June 17th, after months and months of the Bureau stating that it would not be delaying the effective date, they announced that they would, in fact, be doing so because of a failure to comply with a technical requirement under the Congressional Review Act that would have required them to delay the rule by an additional 15 days anyway. So once they realized it couldn't take effect on August 1, they decided they'd go ahead and provide an extra 2 months since industry had been asking for that. So if we could move to the next slide. Then the Bureau actually issued the proposal on June 24th and proposed to move it, in fact, to October 3rd because that was a Saturday, and they wanted to have the divide from the GFE till world that we're in now and to the new TILA-RESPL world occur over a weekend. So we can go to the next slide. All right, it's important to note that this proposal did not propose to alter any substantive aspects of the rule. So all the various things that folks may be unhappy with in the rule, the Bureau didn't propose to change them. And everything I hear is they're not interested in changing them at this stage in the game. It's already we're getting into the middle part of July. The Bureau just wants to, as quickly as possible, get out the final rule delaying the effective date. The comment period closed on Tuesday. So I think everybody over there is running around looking to finalize. And I think the only real question is, will they finalize October 3rd, or will it potentially be later than that? As you probably saw, most of the trades have asked for later through the end of the year. I doubt the Bureau wants to do that, but I honestly right now couldn't guess as to what they're going to do. Another point that a lot of folks have pressed for is the option to comply early. So back to the people who are ready now, asking, well, look, we'd really like to go ahead and be able to comply early, if we can. The Bureau did not propose to allow that. All the signals are they're not going to allow it, and the reason is that the purpose of the new disclosures was that so it would be easy for consumers to compare loans if, in fact, they actually shop. And the Bureau doesn't want a circumstance where the consumer goes, in door A and gets a GFE and goes in door B and gets a loan estimate. They want it to be all or nothing. So with that, we'll just get right into the rule itself. A quick note on scope, what this applies to. Closed-end consumer credit transactions secured by real property other than reverse mortgages. And so, a couple of keys here. It's closed-end, so we're not talking about HELOCs. Reverse mortgages are out, and we're talking about real property. So if the mortgage is just secured by a mobile home or a dwelling that's not secured, not attached to land, a houseboat, for instance, then it's not secured by real property, and it's not subject to the TRID rule. And there are certain other exceptions that are listed here. Moving to the next slide, one of the big questions has been, are co-ops covered? And this is, frankly, an unanswered question, one that we may get guidance from the Bureau on. Not clear whether we'll get it before the rule takes effect or not. The key issue here is that real property is not a term that's defined by federal law, by Regulation Z, so instead it looks to state law and contract. And of course, in some states, shares in a co-op are considered real property, and in some states they are not. And sometimes it can come down to an examination of the individual contract. Bureau staff is informally advised that they intended TRID to apply to co-ops. It's designed to work for loans, co-op loans, and that they would interpret it, expansively as much as they could if some aspect of a state's real property laws, like transfer taxes or real estate, indicates that it's treated as real property. But the problem for creditors is that if you provide the wrong disclosures, you run the risk of suit by a borrower or rescission under TILA. So even if the Bureau is inclined to be lenient here, you still run those risks. So what some folks are electing to do until this all gets sorted out is they're just going to provide both so that they're covered. They'll provide a loan estimate, but they'll also provide a TIL, since they're already set up to provide a TIL. Okay, another question here is what happens with leads on file. There's been a lot of confusion around this specific point. And the question is essentially, TRID says now that an application is 6 specific items. So there's no longer a catch-all allowing the lender to require any additional information it needs or wants before it, before the 3-day clock starts running to issue the disclosures. So with this 6-item definition taking effect when the rule hits, and of course, here as you'll see, this slide reflects the old effective date. We don't have a new effective date yet, but we expect it'll be at least August 3rd and October 3rd. And the language I've quoted here, the Bureau has proposed to amend this with new dates. But the principle that it illustrates is still the same. What the Bureau is saying here in this block quote is that if a creditor receives an application as defined under the TRID rule, so you have the 6 items, on July 31st, so in other words, the day before the rule takes effect, then that is considered to be a transaction to which the new rules do not apply. So you get the 6 items before the effective date. That's a lead. You may have it on file, but it's not a TRID application, and the clock does not start running. But if you get those same 6 items the next day, once the rule takes effect, then that is a TRID application, and you've got to comply with the new rules. Now, I know a lot of folks are sort of daunted by the challenge of trying to track and distinguish between those two things, and so they are planning to, or have already started treating the 6 items as a triggering event, and just plan to start issuing loan estimates for the things that are on file come the effective date, whenever that is. Others find, that process of sort of all these loans sitting in file, and how long has it been sitting there, and is it really an active lead? And they plan to rely on this guidance and try and draw a clear line. All right. So next question that's come up quite a bit is what happens with pre-approvals and pre-qualifications. And just a quick note here, because this is a point that will carry through the rest of this presentation. If you look at the red text at the bottom of your screen, as you're probably already aware, if the mortgage broker provides any of the required disclosures, specifically the loan estimate, then it must comply with all the relevant requirements of the rule, including retention of records for 3 years after consummation, and really any other requirement that applies to the creditor with respect to the provision of the loan estimate. Broker still doesn't provide the closing disclosure at the end of this process, but essentially once the broker has provided the loan estimate, then they're subject to this rule as much as the creditor until the closing disclosure goes out. So you'll see here the rule is generally phrased in terms of creditors, but it makes clear that when the broker has stepped into this role, you read broker in the place of creditor. So I've tried to flag that throughout the slides, but just consider that a general point as we move forward and talk about the other aspects of the rule. So there's been a lot of worry that because of the new 6-item definition of application, and because the rule states that you cannot require a borrower to provide verifying information until you've provided them with a loan estimate, and they've indicated an intent to proceed, that you can't do a pre-approval or pre-qualification or anything where you need the borrower to give you actual verifying documentation of income or something else. So if you need a pay stub to provide a pre-qual or a pre-approval, the rule says you cannot do that until you have a loan estimate and an intent to proceed. But the Bureau said in the preamble to the rule, which is the sort of the long text that comes at the beginning of the rule where the Bureau explains what it did and why it did, that it wasn't their intent to ban pre-quals and pre-approvals. Now, in that explanation, the Bureau said, well, they didn't think that you necessarily needed, for instance, a property address to provide a pre-qualification or pre-approval. Therefore, this sort of existed separately from the rule, and it wasn't going to be an issue. But if we go to the next slide, folks continue to raise concerns that, in many cases you would, have the 6 items, or that the rule read literally indicated you could never ask for verifying information before you'd provided the loan estimate and gotten an intent to proceed. And so the Bureau, in a webinar that it did in May, and the Bureau, these webinars are obviously not in writing. There's not an official Bureau transcript of it, but there are transcripts of these webinars out there, including on our website. They're there for free, so you can find the quoted language, in our transcript, as well as everything else the Bureau said during those webinars. But here, what the Bureau said is, look, really the issue here is that you cannot require verifying information as a condition of providing a loan estimate. The borrower has a right to get the loan estimate by giving you the 6 pieces of information and nothing more if they don't want to give you more. But the borrower doesn't have a right to a pre-approval or a pre-qualification. So it is fine for you to decline to provide a pre-approval or pre-qualification to the borrower unless they give you the verifying information you need. And it is fine for you to review that verifying information and issue the pre-qual or pre-approval, whether you have all 6 items or not. So really these 2 processes exist separately in the Bureau's mind. Once you have the 6 items, whether you have verifying information or not, the clock starts running, you have to provide the loan estimate. And then the real key here for the Bureau is, and this is the first quote on this page, the creditor or broker cannot explicitly or implicitly represent to the consumer that it will not provide a loan estimate without the consumer first providing verifying documentation. So that's the key here. You can't suggest to the consumer that they've got to give you this information or they're not going to get their federal disclosures. So you need to be, I think, very careful in the way you talk to consumers and make sure that nobody's left with that impression. And of course, the safest way to do that is to affirmatively tell them, hey, I need your pay stubs. You still get your loan estimate, but I need this for the pre-qual or the pre-approval. All right. Moving on to the next slide, a question that comes up a lot is the disclosure of lender-paid broker compensation on the new forms, because this is different than the way it appears on the good faith estimate today. As I'm sure everyone knows, the good faith estimate requires disclosure of the compensation that goes to the broker, regardless of whether it's lender-paid or borrower-paid. And then it deals with sort of the distorting effect that has on the numbers through an offsetting credit. The CFPB's forms abandon that approach, and they state that on the loan estimate that the consumer gets up front, only borrower-paid broker compensation should appear on the loan estimate. The general idea here is the loan estimate's a disclosure that goes to the borrower, and it's about the terms of their loan, and things they're not paying for shouldn't appear on the disclosure, and that includes lender-paid broker compensation. And the assumption is, while the borrower might be paying for it indirectly, that's going to be through the origination charge or the rate, those things are reflected on the form, so including lender-paid broker compensation on the form is just going to be confusing to the borrower. So it's off. Doesn't appear on the form, and instead, I'm sorry, if we could go back for just a second, just in case anybody was confused. So what you see here, this is what it looks like on the loan estimate, and you have origination charges. The broker fee here is, that's only going to appear in this box if that's the consumer paying the broker directly. If the lender's paying the broker, then it just wouldn't be there at all. Okay, let's go on to the next slide. So, but here on the closing disclosure, when you're disclosing the charges that are being paid by the broker, by the borrower, by the seller, and by third parties, it is going to appear. It's going to appear in the paid by others column, and you have the option of putting a little L next to it to illustrate that it's being paid by the lender. Now this has raised questions about, okay, how are you going to verify upfront if this is a transaction where the broker is providing the loan estimate and then submitting the package to the wholesale lender? How's the wholesale lender supposed to verify that the broker has priced the loan properly, such that their compensation is paid for through the rate or other terms offered to the borrower? And the answer is that process is going to have to be performed independent of the new loan estimate. You're not going to be able to look at the federal disclosure and figure out what the broker's compensation is going to be. Instead, the lender's either going to have the broker, fill out a form or make a certification or, otherwise indicate the way in which they've priced the loan and the compensation that they expect to get. So, yeah, that will have to be handled separately. All right, let's move on to the next issue, which is estimating cost in terms. And this is really just a general point that applies to all of the disclosures, and I think gets lost sometimes as folks try and figure out, how to fill out all these forms. The entire disclosure has to be provided in good faith. So that's not a requirement that's just limited to the items that are subject to tolerance. Instead, the whole disclosure must be based on the best information reasonably available to the creditor or the broker at the time the disclosure is provided to the consumer. And that means that to act in good faith, you must exercise due diligence to obtain information. However, you can rely on representations of other parties in obtaining information. You can rely on what the consumer tells you. If you've got a realtor involved, you can rely on what the realtor tells you. But what you can't do is disclose something that is inaccurate based on the best information reasonably available to you at the time. So it's just an important point to remember as you work through the process. Okay, let's move on to the next slide. Another issue that comes up a lot is voluntary redisclosure. So the loan estimate redisclosure rules work very similarly to the way the GFE redisclosure rules work today, which is that there are certain circumstances in which if an increase in fee exceeds the applicable tolerance and you have a valid change circumstance, borrower requested change, whatever it might be, other valid reason for increasing the fee, then to do that, you have to redisclose within 3 business days of receiving sufficient information to establish that an exception exists. So that's a condition that then mandates a redisclosure if you want to pass the charge on to the borrower. If you don't care about passing the charge on to the borrower, you don't have to redisclose. But the question has come up like, well, now what if you have the 10% tolerance and you have a change circumstance and it only increases those fees by 6%? The Bureau said very clearly, a change circumstance that increases it by 6% doesn't reset the tolerance. It actually has to hit 10%, and it can build up over time. But what do you do? What if you want to tell the borrower that it's gone up by 6%? Are you allowed to do so? And the answer is yes, you are. And the Bureau said it a number of different times. But if we go to the next slide, as the Bureau spelled out in its May 26th webinar, the issue is that that updated disclosure is not going to reset tolerances if you are providing it voluntarily rather than pursuant to an actual event that allows you to reset tolerances. And that means when you go back, or when a diligence vendor goes back, or an investor, or the wholesale lender, whoever it might be, goes back and walks through the loan file, looks at the different loan estimates, looks at the basis for changed circumstances or other tolerance resets, they need to be able to put that voluntary discretionary loan estimate to the side. And if you don't do that, then you run the risk of messing up your tolerance determinations because you mistakenly thought that voluntary additional loan estimate actually reset your tolerances. So this is another area where you'll want to talk to the lender you're working with because different folks are taking different approaches. Some are saying, look, we only want sort of official loan estimates in the file. We don't want to muck up the file with these voluntary loan estimates. And so they don't want redisclosure unless it's required by the rule. Others do because they feel like it's the better consumer experience, keeps the borrower appraised of what's changing with the costs. Okay. Another item that's come up quite a bit is tolerances and the concept of shopping. And, shopping, and using quotes there because that's a very defined meaning under the rule, has a big effect on how the tolerances apply. If you don't permit the consumer to shop, 0 tolerance applies. If you permit them, but they don't actually shop, then 10% tolerance applies. And if you permit them and they shop by selecting their own provider, then the tolerances don't apply at all. And the question is, well, how do you permit them to shop? You've got to allow them to select a provider subject to reasonable requirements like licensure. You have the loan estimate must identify the services for which the consumer may shop. There's a whole field on the loan estimate just for that. And then, perhaps most significantly, you have to provide a written list of providers identifying at least one available provider for each shoppable service and informing the consumer that they may choose a different provider. So another point here is the written list of providers must be provided within 3 business days of application, just like the loan estimate, and that's going to be the case whether it's the broker or the lender providing the loan estimate. Let's go to the next slide. A question that's come up since the rule came out is, this approach is all fine and good for the initial loan estimate, but what happens if a new shoppable service is added after the initial loan estimate is provided? So, say somewhere down the line, you have your inspection. The inspection indicates that you need to bring a termite inspector out to perform that type of inspection, and the lender wants to allow the consumer to shop for the termite inspector. They want to get the benefit of the 10% tolerance. There's really nothing in the rule that indicates how you do this. And instead, the rule only talks about providing a loan estimate in connection with the initial, a written list of providers in connection with the initial loan estimate. And since providing that written list of providers is part of what constitutes shopping, just a literal reading of the rule would tell you that you're out of luck in this circumstance. There's no way to allow the borrower to shop. But moving on to the next slide, the Bureau picked up this issue in its May webinar and said that they acknowledge the fact that the rule doesn't speak to it, but felt that it is permissible to provide a new written list of providers at the same time you provide the revised loan estimate. So you send out the revised loan estimate saying, termite inspection, X dollars, and you provide a new written list of providers along with that that explains to the borrower that they can shop for the service and provides an available provider for that. So excuse me. Now the Bureau did say that there are 2 ways to go ahead and inform the consumer of, or to provide the list. You can just reissue the old list and add the termite inspector on it, or you can issue a new list that just lists only the new service, in this case, the termite inspector. All right, so let's go ahead and move on to the next slide because this touches on another important issue related to the provision of the service. So sorry about the dinging here. My computer went to sleep and locked me out. All right, I'm back in. So what if the shoppable service is added, and what are the consequences if you get this wrong? You don't get the list out in time, or you don't get the list out at all. Well, the final rule talks about this in the context of the initial written list of providers, and it says that if you allow the borrower to shop, so you tell them, they can shop, you don't prevent them from shopping, but you fail to provide the list, the 10% tolerance still applies. It's not subject to zero tolerance. Here's the language there. But if you go to the next slide, during the May webinar, the Bureau said that if you don't get that revised written list out, then the new service is subject to zero tolerance. So that seems, a bit inconsistent in terms of approach, but that's the guidance that we have from the Bureau. So, in this case, the safest thing to do in this circumstance is when you're talking about a new service that's being added after you've provided the initial loan estimate, if you don't hit your timing requirement with the written list of providers, then you go ahead and, assuming you got the loan estimate out in time, such that you satisfy the tolerance requirement, then you can still charge them for the fee, but it's subject to the zero tolerance, not the 10% tolerance. All right. Moving on, so tolerances and lender credits, just a quick note on this because this has been the subject of a lot of confusion. There are a million scenarios out there about how lender credits work and very limited guidance from the Bureau on it. One thing that is very clear, however, is that in the Bureau's mind, lender credits are subject to the 0% tolerance, and that means they can't change unless you've got a reason. You can't go down unless you've got a reason for it that's fits within the definition of changed circumstance, borrower requested change, or another exception. You have sort of a blanket exception for revising your lender credits when the rate is locked. But there's been a lot of confusion about whether you really can apply changed circumstances to decrease lender credits, and so I just wanted to provide you here at the bottom of the screen with the language in the preamble where the Bureau expressly said that that's permitted. And let's move on to the next slide. Okay, so tolerances and the closing disclosure. This has been the source of a lot of confusion. As you know, there is a point in the process where you make the transition from the loan estimate to the closing disclosure. And this isn't like the existing 2010 RESPA rules where you can provide a revised GFE, right up to and including the closing date. Bureau doesn't want that, and so what the Bureau said is that essentially once you've provided the closing disclosure, you can no longer provide the loan estimate, and in fact you cannot provide a loan estimate on the same day as the closing disclosure. So what that means is that if you are putting the closing disclosure in the mail 6 business days before consummation of the loan, take advantage of the mailbox rule so that you have the presumption that it is delivered, received in the consumer's hands 3 business days before, then that means the last date on which you can send out a loan estimate is 7 business days before consummation. Can't send it on the same day as the closing disclosure. So this means you've got, potentially an extended period where things can and will change. If something changes that isn't subject to tolerance, the rule is very clear on this. You just redisclose at consummation, and you're fine. As long as it's not a change in a fee that's subject to tolerance, and as long as the APR doesn't go out of tolerance, you're okay. But the question becomes, well, what do you do if you do have an event that puts you outside tolerance, but you've got a valid change circumstance for a fee increase, for instance? And what the Bureau said is that you can use the closing disclosure to reset the tolerances as long as the deadline, sort of what I like to call the reset deadline, for issuing a revised disclosure is not more than, is less than 3, it's not more than 3 business days before the date of consummation. And that's always a hard concept to explain, which is why we have some calendars in here that will help us walk through it. If we go to the next slide, so this is the language in the rule that you can rely on for this. And we'll go through some calendars that show you how it works. An important point, though, here at the bottom to keep in mind is the flaw in this whole scheme. It works fairly well as long as you don't provide the closing disclosure too early in the process, or once you provided the closing disclosure, the closing date doesn't get pushed off. Those are the two circumstances in which you can find yourself in trouble. So let's go into the examples, and I'll show you why. So our first example is a simple one. If the initial closing disclosure is mailed or delivered 7 business days before consummation is not delayed, can the creditor charge the borrower for a rate lock extension fee incurred the day before consummation? And the answer to that is yes, and the calendar on the next slide will show you why. All right, so here we've got in green your closing date, which is the 15th. You've got 7 business days before that. You've nailed your initial CD on the 8th. Mailbox rule, your CD is presumed received on the 11th. On the 14th, you learn that mistake was made and the rate lock's about to expire and you need to extend it, and you want to charge the borrower an extension fee for that. That's perfectly fine because as you'll see, if you were still in loan estimate territory, you would have 3 business days after learning that you need that rate lock extension to redisclose. So that's your red arrow here, +1, +2, +3. You would have had to disclose by the 17th. The rule says as long as that date, the 17th, is not more than 3 business days prior to consummation, you're fine. You just issue a new closing disclosure at consummation with the rate lock fee on it, and you're all set. So this one's easy because the event that requires tolerances to be reset is occurring so close in time to the closing date. So let's move to a different example. All right, so next example, can the creditor charge the borrower for a rate lock extension fee incurred 7 business days before consummation? And the answer here again is yes, and let's look at the calendar to illustrate it here. So same closing date, same initial, same initial CD mailing date, and here, I guess I misspoke. The CD was mailed 6 business days before consummation, so apologies. I think I said 7 on an earlier slide. But you've got the rate lock needing to be extended. You learn about that on the 7th. Then you can disclose that rate lock extension on the initial CD that you mail the next day, and that will reset the tolerances because, as you'll see, you've got 3 business days to redisclose from learning that the lock needs to be extended, and that day is not, that 3rd day is not more than 3 business days prior to the closing date. Those are the green numbers counting back from the closing date. So as long as these two things meet up with each other, those 2 time periods meet up with each other and there's not a gap between them, you're fine. So let's talk about what happens when there is a gap between them. All right. Can tolerances be reset if a rate lock extension fee is incurred 1 day before the original consummation date, but closing is delayed by 8 days? And the answer here is probably not, and the reason why it isn't definitely not is you could have a circumstance where the business days fall out in a way that gets you there in 8 days, but generally speaking, not. So let's look at the example and show you what happened here. So you thought you were going to close on the 15th, but on the 14th, you learn the closing's been delayed and you need to extend the rate lock, or it's going to expire. So you've got 3 business days to do that. That would be the 17th. That's your 3 business day period. But the problem is your new closing date is too far away. So when you count back business days from there, and Saturday is always a business day for this purpose, you wind up with it ending on the 19th, and that's why the 18th is in black. That's your black hole. This is the period of time in which you can't use a closing disclosure to redisclose. And the bureaus, acknowledged that this is an issue. They've, devoted a lot of attention to reassuring folks that the disclosures, aren't necessarily going to delay the effective date, but they have warned folks off of providing the CD too early, because that can have the same effect. You provide the CD too early, you can have this black hole as a result, but the same thing happens if you provide the CD and then later the closing date moves on you. So, what do you do about this? The answer is that you want to hold off providing the closing disclosure as long as you can to protect yourself. You can never fully protect yourself if something happens during the walkthrough that leads the closing date to be pushed. Now, if something happens through the walkthrough and you've got to add a seller credit or more money's got to change hands between purchaser and seller, for example, that's not an issue. You just revise the closing disclosure and issue a new one at the closing table. As long as you can close on time, you're fine. It's when the closing date gets delayed that this issue comes up. And the closing date has to get delayed significantly. As you can see here, the dates could fall such that if it's only delayed by a day or two, you're fine. But unfortunately, it's going to be very fact-specific. It's going to depend on when you learned about, the lock extension or whatever the other fee is that's increasing, and then how far away from consummation that actually is. Okay, so next example. So this is the example of providing the CD too early. And the question is, there are a lot of folks out there who want to provide the CD 10 business days before consummation. And can you do that? Absolutely, you can do that. It's fine. What you're exposing yourself to is some risk that you may have a changed circumstance or other tolerance event that occurs, and you're not going to have the ability to reset. So let's go to the example on the next slide. So this is, an example where, essentially what happens here is you provide the initial CD on the 11th, and on the 14th, the borrower requests a change, and that would normally be fine. You have 3 days to redisclose it, but the problem is you've already provided the CD, and you've got the black hole. Borrower requested it too early. So you're not able to redisclose, and in this case, you are, unfortunately out of luck. You can't pass that charge on to the borrower, so then you're left with the question of, well, do you cancel the transaction and start over, or do you just eat the cost? And I'm afraid the rule puts you in this position, but it doesn't answer that question for you. It's a question that the lender is going to have to answer for themselves. All right, let's go to the next slide. There's been a lot of talk about APR tolerances and the APR becoming inaccurate, triggering a new 3-day waiting period. And the answer is yes, if the APR becomes inaccurate, it still requires a new 3-day waiting period, just like it does today. But what's important for folks to remember is that inaccuracy has a very specific definition here. And if it's an increase in APR, it's only inaccurate if it goes up by more than 1/8, or for an irregular transaction, more than 1/4 of a point. If it goes down, then the rule remains that no matter how much it goes down, it could go down by a full point, it is not inaccurate as long as that decrease was a result of a decrease in the finance charge on which the APR is based. So, if you've got your APR, your finance charge, going down, and that drives your APR down, it could be because the interest rate goes down or something that was included in the finance charge is no longer being imposed, then you don't have an issue, you don't have to redisclose, and you don't have to wait an additional 3 days. Now, you do have to sort of walk through a Byzantine maze here of provisions, and I've put them on your screen, but folks have sort of put pressure on the Bureau to say, can't you just say that in plain English? So if you go to the next slide, Bureau did put out a fact sheet on June 3rd, and where they came right out and said a decrease in APR will not require a new 3-day review if it is based on changes in the interest rate or other fees. They could have said finance charges. Some fees are finance charges, some are not, as you know, but the reality is, in either case, it's not going to trigger a new 3-day waiting period. Just something to note here, there is a mistake in the fact sheet. It says that the 0.25% tolerance applies to all adjustable loans rather than irregular transactions. The rule hasn't actually changed. It's still irregular transactions. Those will generally be adjustable loans, but you can have certain adjustable rate loans that are regular transactions and subject to the 1/8%. So just no change there. If you look at the fact sheet, don't let it confuse you. All right. Another change here is that the Home Loan Toolkit, the Bureau has issued a new booklet that replaces HUD's settlement cost booklet. This is going to have to be provided within 3 business days of an application, just like the loan estimate, just like the written list of providers. So if the broker's providing the loan estimate, the broker's got to provide this as well. And you do have some flexibility. You can put your name on the cover if you want to, put your contact information on the cover. There's a Spanish version in the works, but it hasn't come out yet. Go to the next slide. This already covers the timing. The Bureau also, in the May 26th webinar, answered a question that had been floating around out there. A lot of folks wanted to, it's kind of a hassle to have to send out the booklet, thought it was unnecessary cost, and wanted to know whether it was sufficient to just, rather than actually give it to the consumer, to stick it on their website and just tell the consumer, hey, it's on my website if you want it. And the Bureau said, no, that does not work. So you can't do that. Now you can email it to the consumer if you have proper e-sign consent to deliver disclosures electronically. But the key there is you have to have the e-sign consent, and only then can you deliver the disclosure electronically. So you either need to get it and then email them the documents, the loan estimate, closing disclosure, written list, so loan estimate, written list of providers, and toolkit, or you need some sort of an integrated process where they kind of go through, it's a portal or whatever it might be with multiple steps, they provide their e-signed consent, and then it takes them directly to the disclosures. But you can't sort of send them at the same time and you assume the consumer will consent. All right, just a few more notes. I can see we're getting low on time. I want to leave time for questions. So really quickly, just a lot of questions have come up. Obviously, Regs B and C have their own definitions of application for purposes of HMDA and ACOA. And the question has been, well, TRID's changed the definition for triggering disclosure, and other reasons does that change what's an application for HMDA reporting purposes or for ACOA adverse action and other purposes? And the answer basically here is no. The Bureau came right out and said, here's your excerpt where the Bureau said it doesn't change the current definitions. And the Bureau went on to say, if we go on to the next slide, that the definitions of applications serve a different purpose, and therefore the Bureau felt that while it would be in some ways easier for everyone, if there was one standard definition of application, in other ways it would be much harder, particularly if ACOA and HMDA applied every time you had just these 6 items with no verifying information. All right, and then I think the last issue in the prepared remarks is just to make sure folks understand what, how the TRID disclosures work in terms of various loan calculations you have to make. And here, this slide's about your points and fees for QM status, but the same thing applies equally to tolerances and finance charges. These forms do not contain worksheets or charts or anything that's going to tell you or tell the borrower whether you've met the points and fees threshold, whether you've properly itemized the finance charges, and whether you've complied with tolerances. All of those things, as the Bureau said in its May webinar, have to be done off-sheet, quote unquote. So that basically means it's got to be, the loan, the LOS has to track those numbers, as it generally does today, or you need a separate spreadsheet, but you got to have records sufficient to demonstrate compliance with the standards in order to comply with the CFPB record retention requirements. So just a key point to remember here is the forms don't do the work for you. That's got to be handled separately. And with that, I will stop, and it looks like we've got some time for questions.
Great. Thank you very much. We did get some questions, so please, everyone who's still participating, if you do have questions, just put them in the question panel on our webinar panel. If we don't get to your questions today, we have gathered them, and we will be posting a frequently asked questions for you. My first question that came up was, someone asked today, what's considered closing or consummation? Is it the date that the borrower signs the documents or the day the loan funds?
Got it. Okay, so that's a great question, and this comes up a lot. So, excuse me, consummation is a term that's been used for a long time under the Truth in Lending Act, and it means the date on which the borrower becomes legally obligated for the transaction. So generally speaking, that's going to be your signing date, but it does depend on state law, and it depends on the specific contract. If under state law, the borrower is not obligated until the loan funds, and I know that's the case in a lot of jurisdictions, then it's going to be your funding date, not the date the borrower actually signs.
Great, thank you. Next question, settlement costs can vary greatly and not affect the APR. What would large changes delay the settlement, or would it just be loan items?
Right, so there are essentially 3 events that are going to delay your settlement. Your APR has to become inaccurate, and we just talked about that. If a prepayment penalty is added to the loan after the initial closing disclosure is provided, then you would have to redisclose and wait another 3 days. And similarly, if the loan product changes, and product has a very specific definition in here, and it essentially means that you're going from something about the rate or the payment terms changes, such that you're going from a fixed rate to a variable rate, or you're adding an interest-only feature, you're adding a neg-am feature. So major product changes like that can trigger a new 3-day waiting period. But otherwise, changes in your settlement costs, as long as they comply with tolerances, or you can redisclose and reset the tolerances, as we discussed, are not going to change the timing of your closing. You would just redisclose, at closing.
Great, thank you. How do we know what the appraisal fee will be so that we can make sure that it's added correctly onto the LE, or is it okay to estimate now that it's in the zero tolerance bucket?
Right. Okay. So the reason the appraisal is in the zero tolerance bucket is it's a third-party charge for which the creditor does not permit the consumer to shop. So the creditor wants to select the appraiser to make sure that they're comfortable with the valuation of the collateral on the loan. Or at least they want that right. So it's going to be in the zero tolerance category, and that means that once you've estimated it, you're not going to be able to change that amount, or at least not increase it. It can always go down, but you're not going to be allowed to increase it unless you have a changed circumstance or borrower requested change. And the rule provides a fair amount of guidance in the appraisal context about what constitutes a changed circumstance. And it's information that you relied on when you estimated the appraisal amount proves to be incorrect. And it's not just that you relied on the fact that you thought it was going to cost $400 and it cost $500. It's that you estimate that the cost of appraising a single-family home is $400, and the appraiser shows up, and in fact it's a row house. It's something fundamentally different that carries different pricing. That's the example of what the Bureau considers a changed circumstance. Estimating wrong in and of itself, unfortunately, is not a changed circumstance. So that raises the question of, what do you do to get this right, to make sure that you don't wind up absorbing the cost when it proves to be higher than expected. I mean, one is you need to be working with service providers who can give you good cost information up front and that you can rely on. Your estimate is required to be based on the best information reasonably available, so you need to be careful. You can't just highball this thing and rely on that to cover you, because that would not necessarily be based on the best information reasonably available. So it's very, it's very difficult, but what the Bureau has determined is as between the participants in this transaction, the creditor or the broker is the repeat player here, not the borrower. The creditor or the broker is the one in the position to be able to provide the best estimate, and so the risk that it's going to be higher should fall on them and not on the borrower. and that's the judgment that the law makes in this circumstance.
And just as a follow-up question to that, if that appraisal comes back with repairs that the lender, the broker did not realize what was obviously what the appraisal was going to come in when they ordered it, would that be a valid change of circumstance to add a final inspection?
Yeah, absolutely that would be. So, it's the best information reasonably available in that circumstance at the time you order the appraisal is that, you're going to appraise the property and you won't need to go back. And so learning, getting that appraisal report and learning that you need to go back and do a final appraisal after the repairs have been made, I think would be a changed circumstance. And then the key is you've got to get that new loan estimate out within 3 business days.
Great, thank you. And thank you all for sending in a lot of your questions. Unfortunately, we haven't been able to get to all of them. I'm going to ask one final question before turning it back over to Michael, which is, what will the typical brokers, lenders paid, or borrowers paid compensation look like on the LE and the closing disclosure?
Okay, so that's a great question. And you've got this material in your slides, which will help you see what it looks like. As we discussed, the lender paid compensation isn't going to appear at all on the loan estimate, and it will appear in the paid by others column on the closing disclosure as illustrated in your slides. Borrower paid broker compensation will appear under origination charges in the on the loan estimate, and that's also illustrated in your slides. I didn't give you an example of what borrower paid would look like on the closing disclosure, but essentially, if you look at the sample I did give you for the closing disclosure and you see that the broker compensation is all the way over in the right-hand column, paid by others, because it's paid by the lender. If it was paid by the borrower, it would just be on the left-hand side in the borrower paid column.
Thank you very much. At this time, I would like to reintroduce Michael Grant. Michael?
Thank you, Pam. Thank you, Ben. I hope everyone found your presentation as informative as I did. Again, I want to make sure that I remind everyone on the call to find today's presentation on our website at homebridgewholesale.com. We will continue to have these TRID presentations until the official rollout of TRID. So again, thank you for attending today's presentation, and have a great day.